The history of the stock market is punctuated by significant crashes and downturns that have had profound impacts on economies, investors, and financial systems worldwide. Understanding these big falls can provide valuable insights into market dynamics, investor behavior, and the cyclical nature of financial markets. Here, we delve into some of the most notable stock market crashes, exploring their causes, effects, and lessons learned. 1. The Great Depression, 1929. Overview. The Great Depression, beginning with the stock market crash of 1929, is arguably the most severe economic downturn in modern history. The crash started on October 24, 1929, known as Black Thursday, and continued into the following week with Black Monday and Black Tuesday. Causes. Speculative bubble. The 1920s saw a rapid rise in stock prices driven by speculative investments and easy credit. Over-leveraging. Many investors bought stocks on margin, borrowing money to invest, which led to massive sell-offs when prices began to fall. Economic weaknesses. Underlying economic issues, such as declining agricultural prices and industrial overproduction, contributed to the downturn. Effects. Economic collapse. The crash led to widespread bank failures, massive unemployment, and a significant contraction in global trade. Regulatory changes. It prompted the creation of regulatory bodies and reforms, such as the Securities Exchange Act of 1934 and the establishment of the Securities and Exchange Commission, SEC. Lessons learned. Importance of regulation. The crash highlighted the need for regulatory oversight to prevent excessive speculation and protect investors. Economic diversification. It underscored the importance of a diversified economy to withstand financial shocks. 2. Black Monday, 1987. Overview. Black Monday refers to October 19, 1987, when stock markets around the world crashed, with the Dow Jones Industrial Average (DJIA) falling by 22.6% in a single day, the largest one-day percentage decline in history. Causes. Program trading. The use of automated trading strategies exacerbated the market's volatility, leading to a cascade of sell orders. Overvaluation. Prior to the crash, stock prices had risen significantly, leading to concerns about overvaluation. Global factors. A combination of geopolitical tensions and economic uncertainties contributed to the market's instability. Effects. Market volatility. The crash led to increased volatility and uncertainty in global financial markets. Regulatory response. It prompted regulatory changes, including the introduction of circuit breakers to halt trading during extreme volatility. Lessons learned. Risk of automated trading. The event highlighted the potential risks associated with automated trading systems and the need for safeguards. Global interconnectedness. It demonstrated the interconnected nature of global markets and the rapid transmission of financial shocks. 3. Dot-com bubble, 2000. Overview. The dot-com bubble was a period of excessive speculation in internet-related companies during the late 1990s, culminating in a market crash in 2000. Causes. Speculative investment. Investors poured money into internet startups with little regard for profitability, driven by the promise of the new economy. Valuation discrepancies. Many tech companies were valued based on potential future earnings rather than actual performance. Market hype. Media and analyst hype further fueled investor enthusiasm and speculation. Effects. Market. Correction. The Nasdaq Composite, heavily weighted with tech stocks, fell by nearly 78% from its peak. Economic impact. The crash led to a recession in the early 2000s, with significant job losses in the tech sector. Lessons learned. Valuation importance. The bubble underscored the importance of realistic valuations and the risks of investing based on hype. Sustainable growth. It highlighted the need for companies to focus on sustainable business models and profitability. 4. Global financial crisis, 2008. Overview. The global financial crisis, GFC of 2008, was a severe worldwide economic crisis precipitated by the collapse of major financial institutions and the bursting of the housing bubble in the United States. Causes: subprime mortgage crisis, widespread issuance of subprime mortgages, and the subsequent housing market collapse triggered the crisis. Financial derivatives, complex financial products, such as mortgage-backed securities and credit default swaps, spread risk throughout the financial system. Regulatory failures. Inadequate regulation and oversight allowed risky lending practices to proliferate. Effects: economic recession. The crisis led to a global recession with significant declines in GDP, widespread unemployment, and financial instability. Bailouts and stimulus. Governments and central banks implemented massive bailouts and stimulus packages to stabilize the financial system. Lessons learned: systemic risk awareness. The crisis highlighted the systemic risks posed by interconnected financial institutions and markets. Regulatory reform. It prompted significant regulatory reforms, including the Dodd-Frank Act in the United States, aimed at preventing future crises. 5. COVID-19 Pandemic Crash, 2020. Overview. The COVID-19 pandemic led to a rapid and unprecedented market crash in March 2020, as global economies faced lockdowns and uncertainty. Causes: pandemic fears. The rapid spread of COVID-19 and the uncertainty surrounding its impact led to panic selling. Economic shutdowns. Lockdowns and restrictions resulted in a sudden halt in economic activity, affecting businesses worldwide. Supply chain disruptions. Global supply chains were severely disrupted, impacting production and distribution. Effects: market volatility. Stock markets experienced extreme volatility, with major indices experiencing sharp declines followed by rapid recoveries. Fiscal and monetary response. Governments and central banks implemented aggressive fiscal and monetary measures to support economies and markets. Lessons learned. Crisis preparedness. The pandemic underscored the importance of crisis preparedness and the need for swift policy responses. Digital transformation. It accelerated the adoption of digital technologies and remote work, reshaping business models and consumer behavior. The history of stock market crashes reveals the complex interplay of economic, financial, and psychological factors that can lead to significant market downturns. Each crash provides valuable lessons about the importance of regulation, risk management, investor behavior, and the need for diversification. While markets are inherently volatile, understanding the causes and effects of past crashes can help investors make more informed decisions and better navigate future challenges. By learning from history, investors can build more resilient portfolios and contribute to a more stable financial system.